Hi, hello, what's up? So today we are going to start with fixed income valuation, an exciting reading. I hope your calculators are charged, and so are you. Let's start with reading number, whatever the reading is. Let's start with fixed income valuation. Yes. Hello, welcome to the session. Good morning, everyone.
Good morning.
Yes. So we are going to begin with one of the most favorite topics of mine, and that is fixed income valuation. Well, we've done equity valuation, we've done valuation of projects, whether to select or reject a project. But now, fixed income valuation is very unique compared to equity and other investments. So we have already covered the previous readings where we have understood about the fixed income markets overall and how fixed incomes, what are the different types of bonds and the structure of bond and everything. So now is the time to apply your calculators at maximum. Now is the time to apply your time value of money knowledge at the maximum. I keep on repeating this again and again. The reason that we did so exclusive and in-depth calculation in time value of money, I expect that fruit to be received now. So I do expect that those skills will be helpful very much in what we are going to do now, that is fixed income valuation. But fixed income valuation is just not mathematics. It's much beyond that. And before I proceed, let me tell you that in the markets, there may be various equity analysts, but there are very few fixed income analysts relatively. And this is my view. Okay. It can be very much different from someone else. But if an equity dealer is paid, let's say X amount a year, then a fixed income analyst or a fixed income dealer is probably paid 3 times or 4 times of that equity dealer. And the reason is that what you'll come to know when we do the equity when we do the fixed income valuation, that it's not easy. It's not easy, but it's very interesting. It's something what I discovered is very much different from the traditional calculations and mathematical techniques that we do. So I'm sure you all will love fixed income and you all will really enjoy it. Okay, so let's start with fixed income valuation. What you see on your screen is the index. What all things I'm going to cover. The first part I'm going to cover with the valuation concepts, the basics about valuation. Then we are going to understand different types of yields, yield and yield curves later on. That's the most important element in analyzing fixed income. So what are the different types of yields for different types of bonds? And then we will understand yield curve and yield spreads. These are two economic indicators which will tell you not only about a particular bond or bond market, but it will also tell you the health of the economy. So this is what is going to be your, this is what all we are going to cover in this topic of fixed income valuation. So let's start with valuation. Everyone with me? Right?
Yes.
Let's start with valuation. Okay. So multiple things here. Basically, we all know that from the previous topic that bond prices and yields have a positive relation or an inverse relation?
Inverse.
Inverse relation. So if yields are increasing, bonds prices will go down. And if yields are decreasing, bond price will go up. But there is also a relationship between the yields and the coupons, which will tell you about price. For example, if the yields are equal to coupon, then we say the bond is trading at par. If the yields are greater than coupon, why are they greater? Because you're getting something extra. And why? Because you buy the bond at discount. So if the yields are greater than coupon, the bond would be trading at a discount. Correct? So we've understood that relationship of bond in our previous topic, where if the YTM is greater than coupon, the bond is trading at discount. If it is equal to coupon, it is trading at par. And if it is less than coupon, it is premium bond, right? So those relationship is what we are going to apply. However, in order to find a present value of bond, what we simply do is we use the discounting cash flow technique. What is the discounting cash flow technique, guys? Where we simply discount all the bonds' future cash flows. And we know what are the future cash flows. Compared to equity, bonds have certain cash flows in terms of coupon. They are constant cash flows, right? They're similar cash flows for a limited period of time. And that's why we can use a calculator function of PMT, isn't it? We can use the payment function and find the bond's valuation. For that, we need to have the yield, right? So if you have the yield, you can find the price. If you have the price, you can find the yield. That's how simple it is. Clear? So in order to find the present value of bond, we just need to discount the future cash flows. Your PMT is nothing but the payment which you are going to get probably every year or every semi-annual, depending on when the coupon is paid. And on maturity, along with the coupon, you also get one more thing that is called the par value. That is the face value. That's what the value you get back on maturity, correct? And this all will be discounted at YTM. Clear? That's what will give me the present value. So here, if you look out, you have PV, FV, the time period, the discounting rate, and anything else? Anything else? PV, FV, time period, the discounting rates, and the yearly coupons or the semi-annually coupons, depending on whenever the coupons are paid. Clear? So we will be having these 5 things, right? I mean, any of the 4 things will be given. You can find the 5th one. Clear? So we all know YTM. Can someone describe me what is YTM?
Yield to maturity.
Yes. What does it mean? What does yield mean? I've explained you each and every part. Yield means?
It has to...
Returns.
Yeah, return. Yes.
Which can be in the form of coupon or price difference, right?
Price difference. Yes.
Till maturity. That means if you hold the bond till maturity. Remember, in order to get YTM, there is one very important element that you need to hold the bond till maturity. Correct? If you hold the bond till maturity, you will get the desired YTM or the given YTM. Correct? So let's see how do we put that in an equation and find the YTM of the bonds. So here I've given you 4 bonds. You have to find the YTM. They are all annual coupon bonds, and then we'll see the later frequency also. So bond A, maturity 3 years, coupon rate is 7%, par value is 100, and price is 98.5. So, it doesn't matter whether the par is 100 or 1000, it's going to give you a yield. So what I would need right now is to just fill up the details. So in the first case, my PV will be 98.5 negative. Everyone with me?
Yes.
Correct. Why do I put negative, everyone?
Outflow.
Because it's an outflow, correct? So we are going to put that as negative. Your FV, if nothing given, is par, and even if given, it's great. Here, the duration, the bond has a life of 3 years, and the PMT, the coupon is 7% on par, and it's annual, so I'll put 7 years. Is that clear, everyone? With bond B, my present value of investment is minus 1015, and the par value is 1000. My life of the bond B is 7 years, and the coupon is 6% on a par of 1000. So I will put 60. Is that clear? Bond C has the present value of 100, and the par value is also of 100. Its coupon rate is 8% on a par of 100. So I'll put 8, and its life is 4 years. Bond D has a present value of 75. Its par value is 100, and it has N of 8 years, and there is no coupon. That means it's a 0 coupon bond. Am I correct, everyone?
Sir, N 4 C में.
In C, oh my God, yes. In C, the N is 4, and in D, the N is 8. Correct. Sorry. Perfect. So we have 3 years, 7 years, 4 years, and 8 years bond. Our coupon is, in the first case, it's 7. In the second, I've put 60 because the par is 1000. The C part where I have the coupon as 8. Here I have the coupon as 8. Correct? Right? And in D part, there is no coupon. Just check out if the figures are correct, everyone. Everyone?
Yes.
Now, I'll just put out the coupons here that we are aware. What are the coupons here, by the way? Before we go into the calculation, because I am going to do something where, being my students, you all are going to do the calculation. But before putting that into the calculator, we are going to find out the answers. So what is the coupon rate that we have in the first bond? In the first bond, we have 7%. In the second bond, we have 6%. In the third bond, we have 8%. And in the fourth bond, we don't have a coupon, right? And here is what we had, the price. So the price of the bond in the first case was 98.5. So I can say it's a discount bond, correct? In the second one, it's a premium bond 1015. In the third one, it was a par bond. And in the fourth one, it was again a discount bond, a deep discount bond, which is nothing but a zero coupon bond. Now, before you all hit or you all put these figures in the calculator, what I want from here is to compare two things. What are the two things you all are going to compare? The yield and the coupon. But do you have yield? No. So you can check out the price. Well, if the bond is at discount, then can I say its yield will be greater than coupon? If the bond is at premium, that means its yield is going to be less than coupon. And if the bond is trading at par, that means its yield is going to be equal to coupon, isn't it? Everyone?
Yes.
For zero coupon bond, the yield, there is no coupon. So whatever is the yield, that is just due to the price change, right? So I already know before I put the calculator here that my answer of yield is definitely going to be greater than 7%, which is the coupon rate, isn't it, everyone? Clear? So let's go to the calculator and put the figures, everyone. Will you all do that?
Yes.
Minus 98.5 PV, 100 as FV, 3N, 7 as PMT, and let me know what is your I by Y.
7.58.
How much is it? 7.58.
58.
The first one. Just check it, everyone. That's greater than the coupon, so we are correct. In the second one, your answer should be less than the coupon of 6%. So your answer would be somewhat less than 6%.
5.73.
5.7?
73.
73. What is the next one? 5.73. If it's greater than 5, then you need to round it off. Okay.
No, it wasn't greater.
1015.
7.33 something.
Okay. $5.733. So we'll put 5.73. Correct. And if you calculate in the bond C, even after your calculation, your answer is going to be 8%. I'm sure. Correct, everyone. In bond D, your duration there is 8 years in the prices. So 75 will be your PV, 0 will be your PMT, 100 will be your par, 8 is your N, and CPT I by Y. You'll get how much? 3.66. 3.66 would be your answer. Is that clear, everyone? Right? So if you see the conclusion here, since the first bond A is a discount bond, that means its YTM is greater than the coupon, which is what we got, 7.58. Correct. The second bond was a premium bond, so its YTM was less than the coupon. So we got here the YTM of 5.73%. The third one had the same as YTM and coupon was same because the bond was trading at par. And the last one, it's a discount bond. So we just got there the YTM. Everyone. So this relationship should match the relationship of yield and coupon with respect to the price. Everyone with me on this. We are aware about this relation. Anyone, any doubts? Yes?
No.
Everyone clear? So what is the conclusion? When YTM is greater than coupon, come on. The reason I'm repeating it that so that you don't ever forget it and you don't have to memorize it. So YTM greater than coupon would be the situation when the bond is trading at discount or premium?
Discount.
Discount. When the YTM is equal to coupon, that means the bond is trading at par. And when the YTM is less than coupon, that means you have purchased the bond at premium. Is that clear, everyone? Anyone, any questions or any doubts? Right? This is the relationship between the bonds price and yield. But an interesting thing is yield to maturity. That means you will get this yield only if you hold the bond till maturity. Because if you hold the bond till maturity, that's where everything is certain. What do I mean everything is certain? The price at which you invest is certain. The coupon is certain. the maturity and the value on maturity, the redemption value is certain. Everything is certain, isn't it? Correct? So now comes a very, very important thing. And I want you all to highlight, note, or whatever you all want, you all can do it. The YTM is the rate of return on the bond to an investor given three critical assumptions. First, what are we trying to do here? We are trying to understand that you will get the YTM. You will get the YTM provided you follow these three instructions. Okay. The first I told you, what is the first one? Sorry. The first one is that we hold the bond till maturity. Why? Because it is only during the maturity that you get the redemption value by the company, by the issuer, isn't it? If you sell the bond before maturity, is it sure that you'll get the redemption value only? Everyone?
No.
Sell the bond before maturity, then it's not sure that you'll get the redemption value. You may get more than that, you may get less than that, depending on whatever the market demand and supply or the rates are. Am I clear? So the most important thing that for you to get the YTM is that you have to hold the bond till maturity. Everyone. Second important assumption is that the issuer will pay you things, and that too on time. I mean, the issuer will not default. So there is no credit risk. We assume that there is no credit risk. Only then you'll get the YTM, right? What if the issuer defaults? Then you'll not get the YTM. So the second assumption is that the issuer makes all the payments of coupons and principals, and that too on time, and there is no delay or default. Is that clear? And the third, that YTM is based on simple or compounding interest. On what concept? Compounding. So what is the important thing about compounding interest? The important thing is that it assumes the reinvestment also at the same rate. So what is the underlying assumption under the YTM? That you are able to reinvest the coupons also at YTM. Well, this third assumption is somehow impractical. It is not practical and it is difficult. I'll repeat. The third assumption here is somehow impractical and difficult, or perhaps impossible. Why? Because you are assuming that the rates will remain constant for all the 5 years or whatever the life of the bond is, which is generally not the case. Well, if the rates are constant, only then you'll be able to reinvest at the same rate or reinvest at YTM. Otherwise, you will not be able to reinvest at the same rate. And if you're not able to reinvest at the same rate, then your actual return, which is what we call as realized returns, may be higher or lesser than the YTM. Is that clear, everyone?
Yes.
Everyone? Right. So these three things I want you all to keep in mind, because when we will do risk and return of bonds, I will require these three readings, these three important points. So I will write here very, very important, these three important points. These are the crucial points which will define how much things you know better than others. Okay. So if you say that, oh, I will get the YTM, yes, you will get the YTM provided you hold the bond till maturity, the issuer pays you everything on time and in full. And the third is that you are able to reinvest that on YTM itself, which is practically perhaps difficult or impossible. Is that clear? Everyone?
Yes.
Yes. So here I have explained you how to find the yield of the bond. Well, we can also find the price of the bond if we have the yield, isn't it? But now let me change all the frequency. So typically a present value, as I discussed, is nothing but your payment, which is the coupon over the discounting rate. But what if the discounting rate has a separate frequency, which means it can have an annual or semi-annual or quarterly or any frequency? In that case, how do we value the bond? Let's see that. So find the value of the bond with maturity 5 years, coupon rate 7%, par is 1000 and YTM is 8%. This is fixed. But the frequency of coupon is annual, semi-annual and quarterly. Well, in this case, first of all, in the case of annual, how do we change it? How do we use it when it's an annual? It's a simple way that we use, right? What do we use? What are the functions that you are going to put here? Before you put in the calculator, let me know. Your I by Y will be 8. Your FV will be par. Your N will be 5.
5.
Your PMT coupon 70. 7% on 1000, right?
Yes.
And here you're going to find not CPT I by Y, but you're going to find CPT PV. Clear? We are finding the value of the bond. Am I correct? Right? But before you all put it into the calculator, what I want from you all is that let me know what are the features, that what are the inputs for you for a semi-annual bond. Same bond with semi-annual frequency. What is that you will put? Now, remember in semi-annual means 2 parts in a year. So everything will be adjusted. So the I by Y, which is 8 for entire year, will now become
4.
4. Par will remain the same. N.
10.
In 5 years, you'll have 10 semi-annual. You recollect this from QM?
Yes.
Right? And your PMT will be half. That is 35.
35.
Same way, if it's a quarterly bond, then it will be 8 divided by 4. I will have 2%. Par will remain the same. But my N will now be 5 times 4. It will be 20 because in 1 year I have 4 quarters. So in 5 years I have 20 quarters. And my PMT will be 70 divided by 4. So 70 divided by 4 is going to be 70 divided by 4 is going to be 17.5. Am I correct?
Yes.
Now, before you all go to the calculator, tell me, does it matter to the present value of the bond? Will the present value of the bond be affected because of frequency? What do you think? Will the present value of your bond be affected by the frequency? Yes or no?
Yes.
Yes. So your present value may not remain the same. Is that clear, everyone? So let's find for the first one. So for the first one, I will have 8 as my I by Y, my 1000 par value, 5 is my N, 70 is my PMT, everything is going to be in plus. CPT PV, you'll get negative, which is
960.
960.07. Am I correct?
Yes.
To be precise. Right? Now, I just need to change few inputs. For example, my I by Y will be, you will replace 4 as your I by Y. Your par will be the same. 10 will be your N. And 35 will be your PMT. And then if you do CPT PV, you'll get minor difference. And your value will be 59.45. Let me know if you're getting this value. Everyone?
Yes.
So can you find me the value for the last one? 2 will be I by Y, 20 will be N, 17.5 will be PMT, CPT. Yes, anyone?
959.12.
0.12.
2.
Everyone, do you see the value is very different? It's not exactly the same. There is minor difference, but it's not the same. Everyone, clear? So the frequency does matter. Yes. Everyone. So in this way, you can find the value of the bond for any frequency, or you can find the yield of the bond. Everyone clear with this first part? I've directly started with calculation because most of the theoretical part you all are already done. And this topic is what you're going to learn everything with the calculations. So now I want from everyone, and you all can ask me if any doubts. Are you all now comfortable with calculation of present value of any type of bond and yield of any type of a bond? Right? I've covered your premium, discount, par bonds, and even zero coupon bonds. I've covered your multiple frequencies also. Is that clear? Anyone has any doubts in 1A and 1B?
No.
Yes. Divesh? Clear?
Yes.
Okay. So now I'm going to go a step further. See, you all have done the calculation. Okay. Now is the time to analyze it and understand how things are different. So with this grip that you have on your calculation is what now I can proceed. It was this, what I did was more like a warm-up. So now just see what happens. Very interesting. Few things y'all are aware and few things we will understand in the way. First of all, tell me, are price and yield positively related or inversely related?
Inverse.
Everyone, inversely related, am I correct? Right? What do you see on your screen? If you see here, there are 9 bonds overall, A, B, C, D, E, F, and G, H, I. Everyone clear? Now, the first part here is what you can see. The bond is initially priced at 15% yield. Visible? Then I have decreased the yield by 1%. Well, if you decrease the yield, what should happen to the change in price? Should it increase or decrease?
Increase.
Increase. So if you would see, I have put up the percentage change, which is all positive. So if you see, whenever I have reduced the yield from 15 to 14, the change in price of all the bond is positive. Clear?
Yes.
So when I do 15 to 14, you will find the change in price of all the bonds as positive. Now let me draw a few more things here. Now, in the same way, if I change the yield from 15 to 16, I have increased the yield. If I increase the yield, what do you notice? The price changes. The price change is negative for all the bonds, isn't it? Visible, everyone?
Yes.
Now I want answers from you all, okay? What is that you notice? Is the change. First of all, the change in yield is 1% up and down, correct? I've changed the yield by only 1%. I've increased the yield by 1% and I've reduced the yield by 1%. Is that clear? But does it result in the same change in the price of bond? Yes or no?
No.
No, it doesn't result in the same, correct? That's what we are going to analyze. But the one thing that is sure here, that as I increase the yield, the price increased or it fell down?
Fell down.
It did fall, right?
Yes.
As I increase the yield, the price, there was a reduction in the price. As I decrease the yield, there was an increase in the price. So this effect is called inverse effect. What is it called, guys? Inverse effect. Inverse effect is when price and yields are inversely related. Well, in case of bonds, definitely price and yields are inversely related. Any doubts about it? Everyone?
No.
No? Right. Now, the more the change, the more is the sensitivity, isn't it? Sensitivity means change in the price of the bond. I'm sorry. The more the change means the more sensitivity. So higher the change means there is a higher sensitivity. Clear? So I want now you all to focus on coupon. For example, pick up any coupon. You have 3 types of coupon, 5, 15, and 25. Any coupon that you all want to pick up?
15.
15. Let's say 15. So here 15, 15, and 15. Basically, I'll pick up bond B, E, and H. They all have the same coupon. Correct? Now check out at their, what's the only difference between these 3 bonds? They have the same coupon, but
Maturity.
what is the difference? Yes, maturity. B, E, and H. And simultaneously check their change. The change in B is 5.22. The change in E is 6.62. And the change in H is 7%. So if you keep a coupon constant, and just see the difference in maturity. Just see the difference in maturity. Can you tell me which bond is more sensitive? The 10-year, 20-year, or 30-year?
30-year.
The 30-year higher maturity is more sensitive, isn't it?
Yes.
Check out the same for now the 5% bond. Check out the same for 5% bond. A, D, and G. Is it the same? Is it the same? Is that the higher maturity is more riskier? No.
No.
Now let's check out for C, F, and I. That is 25% coupon. C, F, and I. Which bond is more sensitive?
I.
30-year bond is more sensitive. So, did you all notice that this relationship worked in two cases but not in one case? Which two cases it did work? It worked when the coupon was higher than the YTM, isn't it? But did it work when the coupon was very low? Did it work when the coupon was very low? When the coupon was extremely low, like 5%, see the yield are around 15%, and the coupon is 5%. Does this relationship work at that time?
No.
What is this relationship? This is called maturity effect. What is maturity effect? Maturity effect means the bond, if two bonds are same, except the difference between them is for maturity, then the one with higher maturity will be more sensitive than the one with lower maturity. I'll repeat. What is maturity effect? The bond with higher maturity will be more sensitive to the change in yield than the bond with lower maturity. But the exception here is lower coupon bonds. Is that clear? Lower, extremely low. Now there is no quantum of how much low, but as the yield becomes very low than YTM, first of all, when the yields are very much low than the YTM, sorry, my mistake. When the coupons are very much low than the YTM, I'm so sorry. When the coupons are very much low than the YTM, isn't this the case where C bond A, D, and G, where the coupon is hardly 5% and the yields are around 15%. So when the coupon is less than YTM, or when I say when the YTM is greater than coupon, what happens to the price of the bond? What happens to the price of the bond?
Decreases.
Discount, correct?
Yes.
And the more the gap, the higher is the discount. Such bonds, if you recollect, I had mentioned they are called deep discount bonds. The discount is too much. When in such a case, the maturity effect may not play. What is the maturity effect, guys? See, read this. Maturity effect means higher the maturity, higher is the change in the bond price, and vice versa. So more maturity, more sensitivity of the bond, correct, with respect to the change in yield. So let's say if you have 10 bonds, and if it is expected that the yields will increase, what will happen to the price of all the bonds? They will fall or rise. I repeat, if you have 10 bonds and if it is expected that the yields will increase, what will happen to the price of your bonds? Everyone?
It will decrease.
It will decrease, but which bond will decrease the most? Well, the bond with highest maturity will decrease.
Maturity.
Clear? Everyone? But your exception is what? Lower coupon bonds. Lower coupon bonds may not be affected by the maturity relation. Is that clear? Right?
Yes.
Now, let us do one more analysis here. Let us focus on just 10-year bond. 10-year bond. Okay. So A, B, and C is what I'll focus on. Now, what is the only difference between all these bonds? A, B, and C?
Coupon.
Only about coupon,
Coupon rates.
right? Which bond is most sensitive? Highest coupon bond or lowest coupon bond?
Lowest.
Lowest coupon bond. See, whatever relationship I'm saying about positive is the same for negative also, okay? So I'm just focusing on one. Now focus on D, E, and F. All of them have 20 years maturity. Which bond is the most sensitive? The one with lowest coupon.
Lowest.
For G, H, and I, all have 30 years maturity. Which bond is the most sensitive?
Lowest.
Lowest coupon. So, what is the sensitivity relationship here? Which bonds are more sensitive? The one with lower coupons or the one with higher coupons?
With lower coupons.
The one with lower coupon bonds are more sensitive. Lower coupon bonds are more sensitive. Is that clear? Clear. Everyone. So can you all tell me which bonds are more sensitive? First of all, bonds and price have
Inverse relationship.
inverse relationship. Point number one. Second, lower coupon bonds are more sensitive than higher coupon bonds. Third, higher maturity bonds are more sensitive than lower maturity bond.
Lower maturity.
Exception is those with lower coupons. Is that clear?
Yes.
Everyone. This is, yeah, go ahead.
In this example, like the with the when we were comparing the same the same coupon with different maturity, like B, E, and H.
Yes.
So here the coupon rate was 15, and the
E and H have same the coupon rate. B,
yeah,
E, H, right?
yes, same coupon rate, but the different maturity.
Yes.
Like 10, 20, and 30.
So when the coupon is constant and the difference is only about maturity, then the one with higher maturity will be more sensitive.
Okay. So 5%, sorry, the 15 one, it is equal to, like, the coupon rate is equal to the YTM, like 15%. So that's why it is.
No. See, I have changed the yield, right? From 15 to 14. Only then I can find the sensitivity.
Okay.
If you see from 15 to 14, I changed the yield. That's where I got to know what is the change.
Okay. So the coupon should be less than the YTM, not even equal.
I didn't get it. For what?
Like when we are comparing with the lower coupon bonds are more sensitive.
No.
So
hold on. Are you talking about only coupons? Then you need to compare A, B, and C. You can't compare B, E, and H. Because then everything else should be same. The difference should be only about coupon. How do you measure a sensitivity? You measure a sensitivity by keeping all other factors constant and focusing on only one factor that you feel that you want to analyze. If you want to analyze the coupon sensitivity, then just keep the difference in coupon. Everything else should be same. So if I want to analyze the coupon sensitivity, right, or I want to analyze the coupon effect, then either the maturity should be same. I mean, for you the maturity should be same. So you will either take A, B, and C, or D, E, F, or G, H, I. You can't compare B, E, and H. They have same coupon. You can't keep the coupon constant and find the coupon effect. You need to keep everything else constant. So I keep your maturity constant. Then I can analyze the coupon effect. That which bond is more sensitive. I will say, then in 10 years maturity, the lower coupon bond is more sensitive. In 20-year maturity, again, the lower coupon bond is more sensitive. That's how you can analyze.
Okay. But the lower coupon is like, we compare that with the YTM, right? To know if it is lower or not.
See, yes, of course. You and how will you know that if the bond is at discount? That means definitely it's lower than The coupon
The
yield
white
is lower than the YTM.
YTM. So it should not be equal. It should be just less than the YTM.
Yeah, that's what we are saying. That's what
Okay.
coupon. But here, first, hold on. Here we are comparing lower coupon not with YTM, but between the other bonds. So let's say you have 10 bonds. I don't care whether their coupon is higher than YTM or less than YTM. Out of those 10 bonds, the one with lowest coupon will be more sensitive than others.
Okay.
Got my point? So here we are comparing between bonds, not between coupon and YTM. No.
Okay.
Okay. So the sensitivity here is high, not because only it is lower than yield. No. It is between the three bonds, A, B, and C. Out of those, which is the most sensitive? So for example, if you just see B and C, their coupon isn't less than the YTM, but still the one out of two will be more sensitive. B will be more sensitive than C.
Yes.
Okay. So here, no, we are not comparing the coupon and the yield and understanding the sensitivity. No, between bonds of different maturities, the one with lowest coupon out of those, irrespective of whatever that is with the yield, the one with lowest coupon will be more sensitive. Is that clear?
Yes. Got it.
Right. So three relationships. Can someone quickly explain me? Come on. With three relationships, which is what we call
There
as
is the inverse relationship between YTM and the price.
right.
Bonds with the lower coupon rate are more sensitive
Correct.
than other.
Right.
And bonds with a longer maturity are more sensitive than the lower.
Correct. Except the one
for the lowest coupon.
Now, this is the maturity effect is where you can compare the yield and coupon to understand whether the maturity effect will work or not. Only in maturity,
Okay.
not in coupon.
Okay.
So maturity, let's say you have hundreds of bond. The one with highest maturity will be most sensitive. However, if that bond has very low coupon, then its yield, then the maturity effect may not work in that bond. So only in case of maturity effect, you can compare the yield and the coupon in order to understand whether the maturity effect will work or not. And I will prove that in the questions also. We'll solve few questions where you will prove that. Clear?
Yes.
So this is just a chart for you to show how exactly. Now we've done all the calculation of yield and YTM. So you do not have to do the calculation. I've just presented it so that you can understand how bonds are very unique. Okay. Now, let me tell you. Yesterday, not yesterday, in the last session, we did discuss that if you have two bonds with same YTM, but one is a coupon bond and another is a zero coupon bond. Both of them have a same YTM. Which one will you prefer? I remember you all had told me zero coupon bonds. But then I did mention an important thing. What if at the end of, let's say these were both 5-year bonds. One is a coupon bond and another is a zero coupon bond.
Zero.
At the end of the 3rd year, what if both the bonds default? Where have you lost your maximum money?
Zero
coupon bond, right? So if two bonds are of similar maturity and similar yield, can I say zero coupon bond is more riskier than the coupon bearing bond?
Yes.
So two bonds with same maturity and I will add here and same yield. When two bonds have same maturity and same yield, the ZCB, which is the zero coupon bond, is more riskier than CBB. That's a coupon bearing bond. Is that clear? Everyone comfortable with this?
Yes.
Right? Okay, now one more thing before I go ahead, right? The bond's price is affected by due to various things. Out of that we have understood the inverse effect, the coupon effect, and the maturity effect. Right? These are the factors which will affect the price of the bond. I'll repeat, these are the factors which will affect the price of the bond. But the most important factor which will change the price of the bond is the market interest rates. Is the interest rates in the market, which is what we call as market yield or YTM. So your interest rates in the market does not mean the interest rate on your bond. The interest rate on your bond is said as, the interest rate on your bond is mentioned as coupon, and that is constant, right? And that's why we call it coupon, because here when I say interest rates in the market, it does not mean interest rate on your bond. It means the yield in the market. And when the market yields or interest rates change, the YTM on your bond will change and the price of your bond will change. So interest on the bond is called as coupon.
Coupons.
And when I say market interest rates or market yield, that means YTM on your bond. Is that clear? So from now, whenever I use interest rates in the market, I'm talking about yield. When I say interest rate on your bond, that means I'm talking about coupon. So from now, we will never use the word interest rate on the bond. We will rather use only one thing, coupon. So coupon for us is the interest that we get on our bond regularly. And interest rates are nothing but the interest rates in the market, that is yield. Clear? From now, we will use coupon and yield. Yield means interest rates in the market. Is that clear? Don't get confused with interest. Sir, what is interest rate in the market and interest rate in the bond? Well, interest rate in the bond is coupon. We are never going to say that as interest. We are going to say interest rates in the market which are moving, that's yield. Clear? Everyone?
Yes.
Now, in order to further analyze bonds, I need to display you all one very beautiful relationship of the bond, that is convexity effect and pull to par effect. Convexity effect and pull to par effect. Okay. Now let's take any of these examples here. For example, I will take A, B, and C. Just focus on A, B, and C. Or rather, come here. Focus here on A, B, and C. What is the only difference between these three bonds? What's the difference between these three bonds? Yes.
Coupons.
Can you see that, everyone?
Yes.
It's about?
Coupons.
So now here I've changed the coupons. But what do you notice? Is the change in the price. When I change the yield, let's say I change the yield from 15 to 14. So I change the yield by 1% down, sorry. And then I increase the yield by 1%. Have you noticed that the price of the bond here? For example, when I change the yield by 1%, so from 5%, from 15 to 14, how much is the change in the price of the bond? The bond's price has increased by 6.51. Correct? So just for random, calculations, can you actually add 6.51 to 1000? Assume it was 1000 before. Or rather take this, the center one, 15%. I want you all to focus on this bond. If I decrease the yield by 1%, what was the change in the price of bond? Plus 5.22%. So can you add, so here we've added 105.22%. So it is 105.216, correct? So can you tell me why was the bond's value at par? Because
Coupon was equal to YTM.
Coupon. And what was the coupon?
15%.
15%. Correct. Sorry. The coupon was 15%. And therefore, at that point, the bond value was this. Sorry, my mistake. Yeah. Wasn't it something like this? Correct. Now, when I decrease the yield by 1%, the bond's price should go up to 105.22, right? So just see this. Ideally, what should happen when you, let's say, you decrease the yield, right, by 1%. So add 14%. Sorry. Please bear with me. Somewhere the price was here, right? Sorry. Correct. So when I decrease the yield, the bond's price went up, isn't it? But similarly, when I increase the yield, the bond's price went a bit down. Correct. So if you see the bonds relationship is where if you increase or decrease the yield, it's going, it's slanting, it's falling, it's a downward relationship, it's a downward slope. Why? Because price and yields have an inverse relationship. So as the yields keep on increasing, the price keeps on falling. Do you notice that, everyone?
Yes.
So keep in mind, if I decrease the yield by 1%, how much is the increase in price? By 5.22%. Keep in mind that. Okay. So I will write here, when the yields and the coupon was same, let's say when the yield was 15% and when the coupon was also 15%, the price of the bond was at par. Everyone, right? You can say 100. You can put it as 100. So I repeat here, when it was coupon and YTM were same, the price of the bond was par. So I will put here 15% and the price of the bond was par. Now, ideally, when I decrease the yield to 14%, the bond's value should have gone up, isn't it? The bond's value should have gone up. And when I increase the YTM, the bond's value should have gone down. I'm just hypothetically keeping some extra space here. Yes. So where did it actually go from 100 to? From 100 to? Guys. Awake? Everyone?
Yes.
So from 100 to, when I decrease the yield to 15, from 15 to 14%, I know the price went from 100 to 105.22. So basically there was a change of 5.2% on the upside. 5.2% on the upside. Right? But the downside change was 4.83%. So the price fell not by the same rate, but minus 4.83%. Are you getting it? What does it mean? It means that the change upside and downside is not same. Isn't it? Well, I changed the yield by the same rate. So I went for the yield from 14 to 15 to 16. So the change in the yield was 1%, but by changing the yield by equal distance from upside and downside, shouldn't the price of the bond change by the same rate? Isn't that the property we learned in normal distribution, standard deviation? Are you getting my point? In standard deviation or in normal distribution, if you increase two standard deviation on the right or on the left, it should give you the same probability, isn't it?
Yes.
But bonds don't behave that way. the change in the price of the bond upside and downside is not the same, even if you change the yield by the same rate. So bonds do not move in a straight line as it is shown here. They do not move in the straight line as it is shown here. Rather, they move in a curve. And that's why we say the change in the bond price is not linear. They are not linear. How are they? Linear means equal change upside and downside. Is the change equal? No. The change in the bond price is not equal. In fact, it behaves more like a curve. And that curve is what we call as convexity. This difference that you see here, guys, the difference in actual and in what we assume as linear relationship. So since the bonds are not linear, had they been linear, it would have been a straight line, isn't it? If the bonds were having linear relationship, then the upside and downside would have been by the same rate. It would have been a straight line, like elasticity of demand, a straight line, correct? But it's not the case. Bonds don't behave linear. They behave in a curve, and that's what is called as convexity effect. Is that clear? What does convexity effect means? Convexity effect means, see this, convexity effect means that the change upside and downside is not the same. In fact, the upside is much higher than the downside. If you check for 5%, the upside is 6.5, but the downside is less than 6. For 15, the upside is 5, the downside is less than 5. For 25, the upside is 4.79, the downside is less than that. Do you notice that? Everyone. Two things. What are the two things that you notice? Is the change linear or upside and downside?
No.
No, it's convex. And convex means positive convex. Why do I say positive convex? Positive convex means that the positive returns are more than the negative returns. So if I decrease the yield, the positive effect will be higher than the negative effect when I increase the yield. So always the bonds will grow more and fall less for the same change in yield. That's why we call it as convexity. And in what type of convexity? First of all, this curve relationship is called convexity. And what type of convexity do we have? Positive or negative?
Positive.
Positive convexity. What does positive convexity means? It means that the positive outcome is more better than the negative outcome. Is that clear? So if you notice here, the upside is 5, the downside is 4.83. Clear? Everyone? We have an entire reading for calculation of convexity. That time we'll see that in detail. But just to explain you all, what is convexity effect? So convexity effect is an effect where we understand the impact of change in yield on the price of bond, and that is linear or not linear? It's not linear, but rather we say it is everyone.
Convex, positive convex.
Convex, and that too positive convexity. Therefore, the percentage change is greater when there is the yield are less. So the price is going upside is more than the price is going downside when the yields are high. Is that clear? This is called convexity effect. Anyone, any doubts?
No.
Clear? So next time when someone tells you that, okay, the yields are going to increase by 1%. First of all, you know that due to inverse effect, the bond's price will fall, but will it fall? Let's say it falls by 5%. So if the yields decrease by 1%, will the bond price rise also by 5%?
No, more than 5%.
More than 5%. The rise will always be more than the fall. That's called positive convexity. Is that clear, everyone?
Yes.
Right. We'll see this diagram again and we'll analyze and calculate the convexity. This gap that you see here, that's called convexity. Clear? Now, the second effect that I want to put up across is pull to par effect. Now, what is pull to par effect? For me to explain you all what is pull to par effect, I will have to take you all to the spreadsheet. Okay. Are you ready with the calculator, guys?
Yes.
Well, in your calculators, you can put your any number. You can in fact put 1000 also, minus 1000. Yes. Put the par value as 1000. FVS 1000. Everyone. Right? Yield, put the yield as 8% and coupon as 6% on 1000, which is 60. Done? Everyone?
Yes.
Now, if I keep the N as 5, put N as 5. Then the value you will get of this bond, since it's a discount bond. Why? Because the yields are greater than coupon. You'll get 920.15. Am I correct?
Yes.
920.15 today, when how much life is remaining? 5.
4.
5-year life is remaining today.
5. Yeah.
Right? After 1 year, how much life will be remaining? After 1 year?
4.
4. So now in your calculator, just press 4N. And see, you're getting this value 933.76. 4N and CPT PV. Quick. Just two things you need to do. 4N, CPT PV. Keep everything else constant. Don't repeat it. Are you getting 933.76? Yes or no?
Yes.
Can you tell me what is the value that you now get when you put 3N?
948.46.
Again, now press 2N.
964.33.
1N. Gradually, what are you seeing? The price of the bond is increasing from 920 and eventually it is becoming par. So discount bond at the start, even if it is a discount, by the time of its maturity, the bond should become par. So it's increasing, right? Now, contrary to that, a premium bond is a bond where the yields are
less than the coupon.
So now put this thing, put the yield as 5, coupon as 60, and FV as 1000. And then put N as 5. You should get 104.29. Correct?
Yes.
Now, see, this is a premium bond. So as and when its life starts increasing, so the remaining life starts getting reduced, gradually this premium bond will also become par. Just check it out. It will fall to par over its useful life. That's what we call as carrying value. And this is what we have also discussed in FRA, in long-term liabilities.
Non-current liability.
Non-current liabilities or long-term liabilities, one and the same.
Long-term.
Clear? What does it mean? That a discount bond will gradually become par by its maturity. It will keep on increasing by its maturity. And a premium bond will also become par on maturity. So it will start falling. That is what we call as pull to par effect. Do you notice this, everyone? Clear? Right? So I can just switch here any price. If I do minus 100,000, right? I'll just do minus 100,000. Assuming any bond. So whatever bonds you put up, a discount bond will gradually move to par by its maturity and a premium bond will gradually fall to par by its maturity. Is that clear, everyone? This is called pull to par effect. What is a pull to par effect? A pull to par effect is where the bond's price, whether the bond is right now at discount or at premium, by its maturity, it has a tendency to reach back to its par value, right? So the discount bond which trades below par will reach par by its maturity, and a premium bond which are above par will fall back and reach to par by its maturity. Is that clear? Everyone with comfortable with pull to par effect?
Yes.
Right? This is very interesting thing that you all need to understand. Okay. Any questions, anyone? Clear?
No.
So that's where we wanted to understand. First, we understood the bond price and YTM calculation, and then we understood the relationship between bond price and coupon, inverse effect, maturity effect, coupon effect, convexity, and pull to par effect. Clear? So what all things we have studied here? Inverse effect, coupon effect, maturity effect. We analyze that. Then convexity, and now pull to par. Everyone clear about these important things about bond? Very, very important things.
Yes.
Very interesting. Clear? Now let's do some very interesting calculation. And now what I'm going to do is a point after which you can actually, and I'm not kidding, you can actually tell me what will happen to the interest rates in the economy. Will the interest rates increase or decrease? That's what you'll be able to tell me after today's topic, perhaps. But after what I'm going to do now. Okay. So here, first of all, I've put up a 3-year bond example. Well, what is the value of the bond? 3-year bond. How do I find? I need the PMT or the coupons for the next 3 years and the redemption value. That is the par value. And I discount that at the YTM, right? So we use a constant rate, a common rate for all the maturity, right? But tell me one thing. We just know for a fact that are the rates going to be constant for all the maturity?
No.
The rates are not going to be constant for all the maturity. In fact, the rates may keep on changing. Right? So today the rate may be, let's say 5% for 1 year. Will it be the same the next year? Probably not. It may increase or decrease, isn't it? Second, should a 3-year bond or a 3-year cash flow and a 1-year cash flow, should they both be discounted at the same rate? We know maturity effect. What is maturity effect? Higher the
Longer the maturity, more sensitive.
More sensitivity. It means that it has to be more risk and more returns, isn't it?
Yes.
So why are we discounting the bond with same rate? We shouldn't do that, right? That's where we are now going to analyze an interesting thing about bond, that instead of discounting all the bonds with the same rate, all the cash flows of the bond with the same rate, we will now discount the cash flows of the bonds at different rates. And those different rates are called spot rates. What is spot rate? Spot rate is the YTM of a bond for every maturity. So let's say in a 3-year cash flow, you have 3-year bond, you have 3 cash flows, right? 1, 2, and 3 years. If you discount the first cash flow with a different rate, which rate will you discount? With a 1-year yield. 2nd year yield may be different, and the 3rd year yield may be different. When you discount the bonds cash flow with different yields, depending on what are the yields for those maturities in the market, that's what we call as finding the present value of the bond using spot rates. Spot rate means the rate from today for 1 year, for 2 year, for 3 year. I will show you that how it works. Okay. Now, what is spot rate and what is spot curve and all those things I will disclose you in a while. But how exactly I will tell you through an example here, and then all the theory will make sense. So can you read this question for me, please? Yes. 2A.
Given the following spot rates, calculate the value of the following bond. Bond A, par value is 100. Coupon rate is 9%.
Right.
Maturity 4 years.
4 years. Okay. 4 years is a maturity. 1, 2, 3, 4. Okay. Now they've given you spot rates. 1 year spot rate is
6.2%.
Now what is spot rate? It's a rate from 0 to 1 year. Correct? 2 year spot rate means a rate starting from today to 2 years. 3 year spot rate means a rate starting from today till 3 years. And 4 year spot rate means a rate starting from today till 4th year. That's called spot rate. What is the 1 year spot rate that they've told me? 1 year
6.2.
6.2. So anyone who wants to invest for 1 year from today will get how much? 6.2. Anyone who wants to invest for 2 years from today will get 7.2. Anyone who wants to invest for 3 years from today will get 8.5 per year. Okay, per year. These are per year, not once. You will get every year. But if you want to invest for 4 years, then every year you'll get 9.2. Is that clear? It's like, you know what, you do a term deposit or a fixed deposit in your bank. If you do, you go to the bank and you ask what are the deposit rates for the maturities. Bank will say 1 year deposit rate is 6.2, 2 year deposit rate is 7.2, and 8.5 and 9.2, so on. Correct? Making sense, everyone?
Yes.
So now if I want to find the present value of the bond, first of all, what are going to be my cash flows? Just tell me the cash flows of this bond, nothing else. I just want to know the cash flows.
9.
It's going to be 9 because the coupon is 9, correct? So the first year cash flow will be 9, the second year cash flow will be 9, the third year cash flow will be 9, but the fourth year cash flow will be 9 plus the par back.
100.
Am I correct? Now, ideally, how do I find the present value? Ideally, how do we find the present value? We discount all these cash flows at a constant rate, isn't it? At a single rate, right? At a single YTM, isn't it?
Yes.
But now instead of that, I will discount the values, the cash flows of the bond at the respective rates which I got from the market. What is the 1 year rate? What is the 1 year discounting rate? 6.2. So I will write 1.062 for 1 year. So I will do raised to 1. Is that clear? Right? But for the second cash flow, which is after 2 years, this 9 is after 2 years, right? I will discount that with what rate? 1.072.
72.
Raised to 2. Why raised to 2? For 2 years. 7.2 for 2 years. Clear?
Yes.
How about for the third one? For the third one, I will write now 1.085 raised to 3. And the last one will be 1.092 raised to 4. Sorry. 1.092 raised to 4. Is that clear, everyone? This is how I will find the value of the bond. Make sense? Instead of discounting all the cash flows with one rate, now we will discount them at different rates. This different rate. Now don't do the calculation now. These different rates are called spot rates. So what is spot rate? For example, here you can use Z or S or anything. Spot rate for 1 year starting from today. Spot rate for 2 years starting from today. Spot rate for 3 years starting from today. Right? What is spot rate? Spot rate is assuming that it's a zero coupon bond. So what is the discounting rate for that cash flow? That's spot rate. That's called the spot rate. Right? Now, what do you notice? The spot rates are increasing or decreasing? As the maturity increases, The spot rates are increasing. So if I plot the maturity and the spot rates, let's say here is a maturity and here is a spot rate. What do you see? The spot rates are increasing with maturity. I mean, anywhere you can put maturity here and the spot rates. For example, let's say I put this, you have this rate 6.2, 7.2, 8.5 and so on. So what if I put this? Okay, what if I put maturity here and the spot rates? What did you notice in that example? As the maturity is increasing, the spot rates are increasing, right? Something like this. So can I say the spot rates are increasing with maturity, and this curve that you see is curve of spot rates for various maturity. This curve is the spot rate for various maturities. Are you with me on this?
Yes.
And what do you notice? The curve is upward moving or downward moving?
Upward moving.
Upward moving. This is called spot curve. Spot curve or a yield curve, you can say. Spot curve is generally made from treasury bonds, right? From the spot rates. So the shape of the spot curve is generally upward moving. It will tell you that as and when the maturity generally increases, the spot rates also keep on increasing, right? And which bonds have I used to find the spot rates? You can use the treasury bonds, the recent treasury bonds. The recent treasury bonds are called as on the run securities or on the run treasuries. On the run means recently issued bonds. So based on the recently issued bonds from the markets and calculating their yields, you can get the spot rates for all bonds. Let's say you have picked up 4 bonds here: 2-year, 3-year, 4-year, and 5-year bonds. These 4 bonds you've picked up. And if you calculate the yield of these treasury bonds and plot them up, you will get a spot curve. Correct? Everyone? Now, based on this spot rates, now we can find the present value of the bond. Instead of using one single YTM for all the maturities, we will now use the spot rates, which is the different rate for all the maturities. And then what we get the price is much more better or accurate than the previous one where we used to use a constant rate, isn't it? What do you think is much better? Discounting the bond with, with a constant rate, or depending on whatever the yield are for various maturities? So discounting them with spot rate is better, or discounting them with a constant rate, that is YTM, is better? What do you think is much better practically?
Spot rate.
Spot rate, because spot rate represents the risk for various maturity, and we now know that all the maturities do not have the same risk. Higher maturities are more sensitive. So why don't we take that into consideration? Clear? Everyone? Now, I will show you this first calculation because that is very essential. But I'll first show you this calculation, and then we'll do the second one with respect to the same method. What is the technique that we use here? TEC, timeline, equation, and then calculation. Timeline, equation, and that calculation. Do not forget this technique which I've been yelling from QM. Timeline, equation, and then calculation, right? So timeline is very crucial. Have you noted this timeline, guys? Timeline and equation, correct? So now let's go to the function, right? Let me just show you all the calculation technique. Okay. Okay, guys, tell me what are the cash flows in the first year? What was the cash flow? 9 was your coupon, right? So 9, we had discounted 9 with 6.2. So I will do 9 divided by 1.062 equal to and store 1. Put equal to and store 1. Clear? Now the second one was 9 divided by 1.072 square. So first do 1.072 and press square. Done? Now that's in the denominator. So inverse that and then multiply by with 9 and equal to. Store 2. Is that clear? Yes. Third one is
Yes.
8.5 percentage. How do I do for 8.5 percentage? 1.085 raised to 3 equal to, first press equal to, then inverse it, and then multiply with 9 and equal to. Now store 3. You should get 7.0462. Store 3. The last one is 9.2 percentage. So I'll do 1.092 raised to 4 because that's for 4 years. Inverse it and multiply that with not 9, 109. That should be your store 4. And then add all of them. Plus recall 1, plus recall 2, plus recall 3, plus recall 4. You will get 100.00.
Yes.
Are you getting this value, everyone? Correct. So the value that you get is 100.00. I'm ignoring that. Is that clear, everyone? Correct. Any questions, anyone?
It's the same. The price is the same as the par.
Now, coincident. We don't
Okay.
know. It may not always be the same. Okay.
Okay. Okay.
I've actually put it in a manner that you get same, but not always.
Not always.
So for that, I have put up another example here. And we will use the same things that we have done here. The same technique we will be using. The same timeline calculation technique we will be using. And then we will replace it with the things that we have here. Let's see that. What are the things that we have? In 2B, what is the value of the following bond? Coupon rate is 10%. Payment is semi-annually. Maturity is 1.5 years and the par value is 100. So I've changed few things. What are the few things that are changed here now? Very interesting. First of all, it's a semi-annual bond, isn't it? So can you tell me what are the rates and maturity? Yes. Please tell me. What should I take? First, the spot rate for 6 months. So I will take here as 6 months. This will be 12 months. This will be 18 months. And this will be 24 months. Isn't it? Am I correct? Now see, the bond's maturity is only 1.5 years. So you don't need 24 months. But just for the calculation, just for the display, what is the spot rate for 6 months?
3%.
3%. So I'll put here as 3%. Then you have spot rate for 12 months, means rate starting from today till 12 months. It is 3.4%. 18 months means starting from today till 18 months, it is 4.2%. Remember, the rates are always annualized. So it's not 18 months 4.2. It is 4.2 annualized for 18 months. And then for 24 months, it is 4.5%. Is that clear? Now, very interesting thing, okay? When it comes to the present value calculation, things are going to change here. What is going to be the coupon of the bond? Coupon rate is 10% on a par of 100. So ideally it should be 10 for an annual bond, but for a semi-annual bond, it will be 5. Am I correct? So on maturity, I will say I will get 5 plus 100, that is 105. Correct? Yes or no, everyone?
Yes.
Now comes the interesting part. What is going to be the YTM or the spot rate for the first cash flow? It's after 6 months. So it has to be 1.003 but divide by 2, half of it. 3 is annualized. So semi-annual means what would be half of it? 1.03 divided by 2, it will be 1.015 raised to 1 because it's only one semi-annual. Clear? In 6 months, there is only one semi-annual, isn't it? Yes or no?
Yes.
The next one for 12 months, the rate is 3.4. So can you tell me how much is for half year?
1.7.
1.7, right? So 0.017, half of 3.4. But in 12 months, how many semi-annuals you have?
4.
That's why it's raised to 2. Is that clear? So first you break it into half. So it becomes for semi-annual. Then in 12 months, you have 2 semi-annuals. So raised to 2. Clear? Since the bond is semi-annual, you have to take it half. So for 18 months, what would be the answer here? For 18 months, 4.2. So half of it will be 2.1. Half semi-annual. But in 1.5 years, how many semi-annuals you have?
3.
3. That's why I put this 3. Is that clear? Now, hold on. One more thing. What if instead of 1.5 years, I would have put this 2 years? 2 years. Then only one thing would have changed here. Can you tell me what? Let's do that also, right? So then instead of year being 100, I will put 1.025, 4.5 it is. So half of 4.5 is 2.25 and raised to it will be how many semi-annuals you have in 2 years? It will be 4. Am I correct, everyone? So let's make it 2 years so that you can solve it fully. Is that clear, everyone?
Yes.
First of all, everyone comfortable with the equation. Since it's a semi-annual bond, you split the yield in half. You remember that when it's a semi-annual bond, you split the yield into 2. Correct? Here we did that. I've done the same thing. Clear? But in 1 year, there are 2 semi-annuals. In 2 years, there are 4 semi-annuals. In 1.5 years, there are 3 semi-annuals. Yes, tell me.
So in this question, like when there is a payment is semi-annually, so spot rate will be always given in for 6 months, 12 months, right?
Perfect. Yes.
Okay. It will be never a year wise, like
No,
1 year.
see, hold on. Don't say it will be never and that thing. I mean, first of all, it should, I told you previously also that the yields should match to the cash flow. The cash flow won't change. My cash flow is semi-annual. So by anyhow, my yields have to be for semi-annual. Point number 1. Second, now I need 6-month rate. Then I need 6-month rate after 6 months. Or I need 12-month rates. So you need either this or full this. When is your cash flow? The second cash flow is at the end of 12th month, right?
12th month, yeah.
So you just need the discounting rates till 12th month, which can be directly given or which cannot be directly given. If not, we will see how to calculate. But your focus should be that I need the discounting rate from that point to 0.
Okay.
Now, if given, easy. If not, how to do that? That's what we are going to learn. That is forward rates. What is forward rate? Can you just read that so that you'll get clear what exactly we are going to do? Yes.
Forward rates, the annualized interest rate on a debt to be initialized at the future period is called the forward rate for that period.
Yes. So you have spot rates, which are going to start from today. So what are forward rates? Forward rates are those rates which will start at some point of time in the future, not now. So you have a spot curve. In the same way, you can prepare a forward curve. But what's the use of this forward curve? Well, from the forward curve, you can find the spot curve, or from the spot curve, you can find the forward curve. You can use them interchangeably. And I will show you how. So your question that will we be given always? Yes, you will be given it. But even if not given, we are ready to find that how. And I will show you that how. Don't worry. Okay.
Yes.
So clear till this point, everyone?
Yes.
Now, what I was trying to tell you is that we'll find forward rates means that here you have the rate starting from today, right? But later on in the later part of the topic, not now. See here, when we'll be doing spot and forward rates again in the later part. That's going to come at the end. In that part, I'm also going to teach you how to find the rates between 6 and 12 months. How to find the rate between 12 and 18 months using the spot rate. These are called forward rates. The rates between 6 and 12 months is called forward rate. Are you getting it? These are called forward rates. And how to calculate or derive that? Well, that's what we'll see very soon. Okay. Clear? But not now. Right now, just ignore it. Right now, we are going to be happy with the fact that we will be given the spot rates to find the present value of the bond. And that's what we need. Is this timeline and equation clear to everyone? I've just changed this bond to 2-year bond. Everyone clear with timeline and equation? Only then will I move forward. So, have you noted down these cash flows, everyone? So now let me place that into the calculator. Okay. So tell me, what was the first cash flow? You had 5 as your semi-annual coupon and divided by 1.015. So first I will do 5 divided by 1.015 equal to store 1. Correct? What was the second discounting rate? 1.017 square. So do 1.017 square inverse multiply by 5 equal to store 2. Clear? The third one was 2.1. So 1.021 raised to 3 inverse multiply with 5 store 3. And the last one was 2.25. So I'll do 1.0225 raised to 4 inverse, but multiply with 105 and store 4. 105 coupon plus par. Now add all 4. Recall 1 plus recall 2 plus recall 3 plus recall 4. I'm getting 110.52. Just recheck that. Recall 1 plus recall 2 plus recall 3 plus recall 4. Are you getting this value 110.5?
Yes.
Correct. So 110.52 is the value of our bond. 110.52. Clear, everyone? Any doubts, any questions, anyone till this point? Yes. Everyone understands what is spot rate and spot curve? Instead of discounting the bonds with one constant rate, now we are going to discount the bond with rates for various maturities, and that's what spot rate is. Where do you get spot rates from? Well, you can get spot rates from the value of the bonds issued for various maturities. You can get that from treasury bonds issued for various maturities, and from those maturities you can find the yield for various maturities, plot them in a curve. That's what spot curve or yield curve is. Okay, I'll just show you one glimpse of that spot curve. Of course, we are going to do that not now, later on, but this is how a spot curve looks like. or a yield curve looks like. Do you notice that? It's the latest one. What is that you notice? That these are treasury bonds issued for various maturities, right? And that's the yield for all those bonds. And it is upward moving or upward sloping. What effect does play here? What effect is it playing here? What type of effect? Maturity effect. Higher the maturity, higher is the yield. Visible? Everyone?
Yes.
So this is just a short glimpse. We are going to come at this point and discuss in detail about the yield curve or the spot curve, but we just have some more things to do before we reach there. Clear? So now we have understood how to value the bonds. So see, I started with how to value the bonds using YTM, but then we understood that yields are, when we understood the maturity effect, we realized that the yields are not going to be same for all the maturity. Therefore, now we are valuing the bonds using the yields for various maturities, that is spot rate or spot curve. And based on that, now we find the present value of the bond. Clear? This is more practical and more logical, isn't it? Right? And now if you notice the technique that we used in time value, that is going to be helpful here. The equation, the timeline, the calculation, those techniques will be helpful here. Clear? Clear? Anyone has any doubts? Let me know. Anyone, any doubts? I hope you all are solving with me, right? Or you all are just watching, because these are the things that you can't do by just watching. Okay. These are the things that you can only do by manually solving simultaneously with me. Clear? At least timeline making and equation making is crucial. Calculation is easy, but timeline and equation making is crucial. Should I move to the next point, everyone? Clear with spot rates? Okay. Now we are going to understand one interesting thing. And that interesting thing is with respect to the problems in the bond. What is the problem in the bond? Well, in US, bonds are issued with different day count convention. Day count convention or DCC. It means that some bonds are issued with calculation as 30 by 360. What is 30 by 360? Where we assume the interest will be paid for 30 days in a month or 360 days in a year. Clear? But then there are some bonds, especially the government bonds, they are not issued by 30 by 360 rule. They are issued by actual days. So two types of convention are used. Actual by actual days or 30 by 360. Actual by actual assumes exact days in a year. But 30 by 360 assumes 30 days in a month, irrespective of whichever month that is, May or February, and 360 days in a year. Is that clear?
Yes.
So government bonds generally use actual by actual, corporate bonds use 30 by 360. Right? So we have this function in our calculator to calculate this days, exact days. So first of all, even without our going to the bond function, I have put up here date, 2nd March and 2nd September. How many months are there between 2nd March and 2nd September? April, May, June, July, August, September. 6 months, right? So if I assume 30 days in a month, so in 6 months, how many days should I get? 180, isn't it? Everyone?
Yes.
All right. But if I assume 360 days in a year, however, if I assume exact days in a year, then I will have to manually calculate, right? How many days in April, May, June, July, and all. Right. But don't worry, friends, because we are all lazy, CFA Institute knows that, and they've given us some functions in the calculator. So BA2 Plus Professional has that function to calculate exact days. How to do that? Let's see that. So between 2nd March and 2nd September. But before I go to the date function, the date function is, by the way, second one. When you press second one, you'll get DT1 on your calculator. Press second one. Do you get this DT1 on your calculator screen? Now the format of the date there is American, which is MMDDYYYY. It's not the Commonwealth method of DDMMYY, okay? Which is there in UK and India. The method there for date calculation is American. It is MMDDYYYY. Clear? So how to put that date? So what is the first date here? First date. 2nd March 22, right? So listen this. March means 3. So you have to put 3.02 is the date 22 and enter. Put into your calculator with me. 3.0222 enter. Are you getting on your screen? March 2nd, 2022. Yes or no?
Yes.
So now for 2nd September 22, I will put 9.0222 and enter. Correct? 9. When you go to DT2, put 9.0222 enter. I hope the calculator has taken September 2, 2022. Clear, clear. Now, when you press down arrow, what do you get on your screen? When you press down arrow, what do you get? DBD. So it is going to calculate days from the point where you had put date 1 to date 2. But before you calculate compute, before you press compute, I want you to press one more time the down arrow key. And what do you see on your screen?
ACT.
ACT. Well, if it is ACT, it is actual by actual. Or you may see 360. Anyone seeing 360 on the screen? Or ACT, everyone?
ACT.
ACT. Okay. ACT means it is going to take actual by actual days. Now press up arrow. Up arrow. Again, you are at DBD.
Yes.
Correct. Now press compute. And you will get exactly 184 days. Am I correct?
Yes.
Right. But again, if you go and press down arrow key, if you want to change ACT to 360 days, then press second enter. Then your ACT will be replaced to 360. Clear? Are you getting 360 on your screen?
Can you repeat again, like second for 360?
Second enter, I've written on the notes also. Just see on the screen. Second enter, that's what you need to do. When you go to ACT, press second enter. That ACT will be replaced with 360. Okay, not? Wait, I will show you. Okay, so what did you do? Press first, second, first. Your date 1 is this on my screen, visible?
Yes.
I press down arrow, I get September 222. Then I press down arrow, it is DBD, but I press down arrow, it is 360. Now in your case, it was actual like this, right? ACT. So reach on this screen, this point, ACT.
Yes.
Now if you want to switch, press second enter. Second enter. Then press up arrow key and then now press compute. You will get 180.
Got it.
Got it? Yes, Divesh?
सर मेरा DPD कुछ अलग ही आ रहा है.
No, but I need to know what are your figures. Have you put DT1 and DT2 this? Check your DT1.
2nd September
No, DT1. Is it exactly as it is on my screen?
No.
Then you need to change it. What have you put it? Have you, so do it with me. 3 dot, press 3. See this 3 dot
Okay.
0 to 22 and press enter.
Okay.
Have you
Yes.
got this on the screen?
Yes, sir.
Now press down arrow. Press 9.0 to 22. Enter. I told you it's MMDDYY.
Yes.
Now press down arrow and now press DBD compute. Press compute.
Yes, sir. 180.
180 because you've taken 360, right? So now press down arrow, you'll get 360 on your screen. Correct?
Yes. Yes.
Now if you want to change the convention to actual by actual, press second enter. Okay. Second enter, your screen will change from 360 to ACT. Is that happening or not?
Yes, sir.
Now go and press up arrow key and again press compute. You'll get 184. Clear? Compute. Press compute. You'll get 184. Right? So see, this is the way you have to put the functions I've mentioned here. Now in this way, you can solve any dates. Everyone with me? See, there is one way of doing it that is manual. And then the other way is this. Can you believe that I did my level 1 without knowing or using this function? And I manually literally did everything. I mean, I realized that after years that, oh, I had this function in the calculator. I never used it. This is the problem when you refer some notes like Schweizer. They don't mention you this in there. Are you getting me, everyone? Clear? So next time when you want to calculate date exactly, you don't have to worry. You can just use the date function. Anyone has any doubt with this? Now, of course, CFA Institute is not going to ask you the number of days only. It will be part of a bigger picture. So it will be part of a sum. Correct? And what is it going to be that we are going to do now? Why are we using the date convention? First of all, everyone clear with the day count convention? There are two types, actual by actual or 30 by 360. 30 by 360 is very easy. But why? Because we assume 30 days in a year and 30 days in a month and 360 in a year. But actual by actual is where you need exact dates, which will also include leap year and everything. But how am I going to know whether I have to use actual by actual days or 30 by 360? Well, that will be mentioned to you in the question. So if you see here in the question, it's written DCC 30 by 360. DCC here it will be written DCC actual by actual. Written. The bond is price. Yeah. So see this here. Visible, everyone? Clear? Yes or no? Everyone, let me know. If you're not clear,
Yes,
I will repeat it. Both of you all. Because now the calculations are going to be very crucial. If you miss the bus, it will be difficult for me to come back and pick up your. Right? Now it's not an easy job. It's difficult, but if you follow my instructions, it will not be difficult. If you don't follow it, or if you think, for those who are not attending today, if they think that, I'll just see the notes and I'll be able to do it. No, it's not that something you can just refer it by the notes and do it. Of course, now you have an video option, so you feel it. Yeah, if not now, I'll see it later, but that's not the case. There are some things that you'll have to do with me so that I can keep sitting on your head and make you do that. I can keep on irritating you until you get the answer, right? Okay, so what are we going to calculate? Why are we using the DCC convention, the day count convention here? Well, we are going to use that in a calculation of bond price. Well, our focus entirely on this topic is valuation of bond. Valuation of bond. That's what the topic name is, right? Valuation of the bond. Valuation of the bond. But guys, what was one common thing till now? you did value the bond at exact on the dates, 0th date, that is today. So you value the bond on exact frequency, that is on 0th date, or let's say at the end of 5th year or 0th year, whatever. What if you want to value the bond between the two coupon dates? What if you want to value the bond between two
Coupon dates.
Coupon dates? Then there is a fight between the buyer and the seller. Why is there a fight? Well, the seller will say that if I'm selling you the bond between the two coupon dates, the seller will lose out something. What will the seller lose out? The seller will lose out the coupon which is accrued till date, because now that will belong to the new buyer, isn't it? That coupon will now belong to the new buyer. So the seller will have an issue with that. Now, what is that issue exactly? How is it addressed? And what is the issue of accrued interest, which I just mentioned? That's what we are going to learn. And you will, let me assure you, you will find this type of question in exam. You will definitely find. This is one of the institute's most favorite topic. Now, I'm not going to read out these stuffs unless and until I display you a question and make you realize what is an exact problem here. So I want someone to read it so that I can place up that in our, what is our technique, guys? What is that technique? Come on, repeat. What is the technique? What do we do? How do we solve the present value? Does it happen automatically?
The timeline.
TEC. How do we solve TEC? What is a tech? Timeline, equation, and then calculator. You are not going to touch the calculator before you put up the timeline and equation with me. Right? So read the question and help me plot the timeline and tell me what has happened exactly. I will explain you the concept after we plot the timeline, because that's where you will understand what exactly is the situation here. Okay, read that. Deepti, can you read that, please? Yes.
What is the full price, flat price, and accrued interest for the following bonds?
Now, we don't know what is full price, what is flat price, what is accrued interest. So we don't know that. We are trying to understand that, right? So what is after that? Let's read that.
Bond issued by a Norwegian company per 1,000
Norwegian krona.
Yeah. Coupon rate 3.2%. Coupon payment on 2nd March and 2nd September every year.
Hold on. So the coupon, hold on. The coupon payment happens on
2nd March and 2nd September.
March and 2nd September every year. These are the dates on which the coupon is paid, right? Correct? Yes. Go ahead.
Discount rate is 3.2%.
Okay.
Maturity date is 2nd March 2027.
That's way far. Okay.
And settlement date is 24th July 2015.
Yes, hold on. Settlement date is 24th July 2015. Now 2015. Now my 24th July is actually the date between March and September, isn't it?
Yes.
Now this is called settlement date. Settlement date is called as SDT. By the way, you can say the selling date of the bond. Settlement date. What does it mean? This is the date on which you and I are exchanging the bond. So I'm selling the bond and you are buying it. But isn't this date between the two coupons? One coupon which is already paid and another coupon which will be paid. Correct?
Yes.
Remember, the coupon is semi-annual year. Why? Because it's paid twice in a year.
Twice in a year.
So I should rather say C by 2, C by 2. Clear? Now, I want your support here, please. Everyone. Now, who gets the coupon? Actually, the one who is the owner of the bond on that day, isn't it?
Yes.
Now, let I be the seller of the bond. I'm selling you the bond on 24th July, right? From 2nd March till 24th of July. From 2nd March till 24th of July, wasn't the bond with me? Correct? I sold you the bond on 24th July, right? But the company is going to pay coupon on, company is going to pay the coupon on 2nd September. Who will get that coupon? Will I get that coupon or the new buyer will get the coupon?
New buyer.
New buyer. And how much coupon will the new buyer get? Will he get entire coupon? Yes, he will get the entire coupon right from 2nd March to 2nd September. But does it entirely belong to the new buyer?
No.
No, I was holding the bond till 24th July. Shouldn't I get the share of that part? That share of mine is called accrued interest. Are you getting me, everyone?
Yes.
So, one very important thing. The market price of the bond, on 24th July is called the flat price or the clean price or the quoted price. What is it called? Flat, clean, quoted price of the bond. Okay. But will I actually sell you the bond only at that price? No. I will sell you the bond at that price. Plus, I will also take from you what? I will also take from you my share of accrued interest because you are going to get that. Isn't it?
Yes.
So, will I actually get only flat price or plus accrued interest also? When I sell you the bond,
interest.
when I sell you the bond, I will get flat price plus the accrued interest. So when I add the flat price plus accrued interest, that's called the full price or the dirty price. Is that clear?
Yes.
So very, very important thing. First of all, flat price also has a name clean price because that's the price actually traded on the screen. But that's not the price that you pay. You will have to pay flat price, that is clean price, plus accrued interest till the settlement date. And then when you add this accrued interest, the price that you get is called dirty price or full price of the bond. Is that clear?
Yes.
So if I add the accrued interest to flat price, that's where I'll get the full or the dirty price. That's the actual price paid by the buyer of the bond to the seller of the bond. So you can't argue that, oh, the price is only 100. No, it's not only 100. You'll have to pay me 100 plus the accrued interest till that day. That's called the dirty price or the full price. Everyone with me?
Yes.
Now the problem is of the days and the exact interest calculation. But fortunately for you all, everything is there in the calculator inbuilt. Now, where is it? I want you all to press second 9 on your calculator. Second 9. Please be with me here. Okay. Second 9. I will first show you what has to be written. So do write with me. What do you see when you press second 9 on your screen? The first thing. SDT, that is the settlement date. What is the settlement date here, guys?
24th July.
24th July. So I write 7.2415. So 7.2415. Clear?
Yes.
Press down arrow. What is the next thing that you see on your screen?
CPN.
It's coupon. But remember, this coupon is annual. So what is our annual coupon? Our par was 1000, 3.2%. So even if it's a semi-annual, but you are going to write here annual coupon. How much will be my annual coupon? 32. Everyone, please write down because we have to, the calculator function is inbuilt where you have to write the annual coupon here. Clear? Everyone? Yes or no? 32, enter. Press the down arrow key. What do you see on the screen?
RDT.
RDT is actually the redemption date. The redemption date is here. See this, March 2027, 2nd March 2027. How do I put this? 30227. Press it, 3.0227. I hope Divesh, you are following with me. If not, it will be difficult for me to come back. Okay. Everyone?
Yes.
What is the next thing that you get on your screen?
RV.
RV means the redemption value, which is 1000. Here we have 1000, correct? See here, the par is 1000. Have you written the par? Have you put up the par value 1000?
Yes, 1000.
Now, when you press down arrow, what do you get on your screen, everyone?
ACT.
ACT. But here they have asked me for 30 by 360. If you have ACT, change it by pressing second enter. If not, if it is already 360, don't do anything. So I will change it. If I had ACT, I'll change it by pressing second enter. Once I see 360 on my screen, then press down arrow, down arrow. Now, by default, you will see on your screen something. What is that?
2 by Y.
Are you seeing that, Divesh?
Yes.
Now, that is going to be the case by default always, because you will always get bonds with semi-annual frequency, and semi-annual frequency is inbuilt in your calculator. So that means before you ask me question, will I get, sir, quarterly bond or monthly bond? No point of such hypothetical question, because the calculator is built in this way only, and you will get this type of questions only. So you will get semi-annual bonds only, and between those semi-annual, you'll be finding the value. So by default, this will be your function. 2 by Y is frequency twice. Why it's the frequency twice? Because it's a
semi-annual.
And that's why I kept the coupon here as 32. I kept the annual coupon, which will now be adjusted when the frequency is 2 by Y. Clear? So you don't have to change here anything. You have to keep as it is, because by default, it is 2 by Y in your calculator. You don't have to change that. It will always remain this. Am I clear, everyone?
Yes.
Now, when you press down arrow key, what is it asking you? Yield. What is the yield of this bond? See this, the yield, they have given the discounting rate is 3.2. So just press 3.2, enter. Everyone with me?
Yes.
Now, guys, before I do the calculation, you know, when the yield and coupon are same, the bond's price should be par, isn't it?
Yes.
Correct. So when you press down arrow, you get on your screen PRI. Are you getting it?
Yes.
Press compute. Press compute. It will give you 999.99.
9.96.
Are you getting this 1000 on your screen, everyone?
Yes.
Now, when you press down arrow, you'll get accrued interest. Press down arrow, you'll get AI. Press compute, or it will be ready-made. That is how much?
12.62.
Sorry?
10.6667.
Why is everyone getting different? Just a moment. 7, 24, 15. Just check your dates and everything. Settlement date, coupon, redemption date, RV 360, 2 by Y. Remember, a lot of people do RV as 100. Keep it 1000 here. Okay. Yield 3.2. Price is 999. Accrued interest, I get 12.62. Are you getting 12.62?
Yes. 12.62.
This is what you should get exactly. Are you getting, everyone? If not, if you don't get this answer, then you need to check your figures. You have the calculator option by going up and down arrow. You need to check here exactly what I've written on the screen. If you've not put any of these things, you won't get this AIS 12.62. Is that clear? Now, when you add this, you will get 1012.62. That this part you may have to do manually. So if you do this, you will get your full price or dirty price. Everyone. So what will be the price of the bond in the market? 1,000. But how much will you write a check to buy this bond? You'll pay not only 1,000, but also the accrued interest. This accrued interest of 12.62 is for the duration between
March to July.
Yes, 12.62. Do you want to verify this accrued interest? Do you want to try? Or are you okay?
Verify.
Do you want to verify? Yes.
Yes.
So, do you know how to use the date function? Day count convention. Right? Go to second one. Second one.
Yes.
Right? What is the first date? 2nd March 2015. So, right? 30215. Enter. 30215. Enter. The second date you will write is 24th July 15. So, write 7/24/15. Enter. Got it?
Yes.
Now check your day count convention. Is it 30/360 or actual by actual?
Actual.
So change it. We need 30/360, right?
Yes.
So change it. Second enter.
Yes,
And then go to DBD and let me know how many days you have.
180.
Sorry? How can it be 180? Compute. Press compute. You need to press compute.
142.
142. 142 out of 360. So now in your calculator, do 142 divide by 360. And what was your coupon, by the way?
32.
32. Multiply that with 32. You'll get 12.62.
12.62.
Inshallah. Correct. Everyone. So that's just for your verification. You don't have to do it manually. The bond function does it automatically for you. Are you getting it? Do you now realize why did I make you do the day count convention? You don't have to do it in exam. Why? Because the bond function will itself capture it automatically. Is that clear, everyone? Interesting it is, isn't it?
Yes.
You're finding the value of the bond not on the coupon date, but somewhere between the two coupon date. And that's why this becomes very, very crucial, very interesting. Don't worry, I'll do one more sum, which will ensure, and I will do that along with you in the calculator, and I will ensure that this thing is freezed in your mind. But what is the concept here? What is the concept of clean and dirty price? Can you read what is clean price, everyone? It is a price at which bonds are actually traded or quoted in the market. But this is not the price that you pay. Why? Because this does not include the accrued interest. What is accrued interest? Accrued interest is the interest from the previous coupon date till the settlement date. Settlement is the date at which you are probably selling the bond or valuing the bond. So when you add accrued interest to the flat price, that's where you get the full price. Now there is a manual way of doing it. I have not told you to use the manual way because the calculator itself has all the functions here. The calculator itself will do the job. And in order to do it manually, you can manually also do it, but that's going to be very much time consuming. Rather, you just use the bond function, which is inbuilt and specially made for you. Use the bond function, but do the timeline, put the bond function, and this is how you will get the answer. So now in the exam, in the choices, they may give you they may ask you what is the flat price or what is the accrued interest or what is the full price. You just have to tick mark whichever the choice that is. Clear? I'll do one more example for you all to practice. Don't worry. But understood the basic concept?
Yes.
Everyone? So are you ready to do one more sum? Right? Even if you all are not ready, I'll make you all ready to do it. Okay. So now this sum we will all do together, ensuring that there is no error. First, what is the technique that we use, guys? TEC. I need first timeline, the equation from you all, and after that we'll go to the calculator and put everything. Clear? So timeline, equation, and calculation. Ready, everyone?
Yes.
Okay, so go ahead. Can you read that, Deepthi? Yes.
Consider a 5% semi-annual coupon payment government bond that matures on 15th February 2028.
So it's going to mature on 15th February 2028. It's a 5% semi-annual bond, right? Okay, so the coupon will be paid twice.
Yes.
Right, go ahead.
Accrued interest on this bond uses the actual
Over actual
day.
So it is actual by actual day count convention, right? Next.
The coupon payments are made on 15th February and 15th August each year.
Hold on. So the coupon payment is on 15th Feb and 15th August, right? And you are on 2019. So it's year 2019. It's year 2019. Correct? Why? How did I come to know it's 2019? Just see the details ahead. They've said that the bond is priced for settlement on 14th May 2019. So 14th May is somewhere between 15th February and 15th August. Everyone?
Yes.
What is 14th May? It's my settlement date. Is that clear? Right? So my settlement date, I will have to find. My settlement date is between the previous coupon and the next upcoming coupon. That's where I'll have to find the value of the bond. Now, they have given me the annual yield to maturity is 4.8%, par value is 1000. Everyone, what are the things that I need to put? What is the settlement date? Can someone tell me? What are the
14th
things?
May.
No, I know it's 14th May. How do we put it here?
5.1419.
Yes, 5.1419. Correct. Coupon, it's 5% semi-annual. 5% semi-annual on 1000 par.
50.
50 for entire year or half year?
Entire year.
Entire year. And we have to put the entire year coupon, correct?
Yes.
You do not have to adjust the coupon here because that will be adjusted when you put the frequency.
Yeah.
Because the frequency by default is 2 by Y. So here you have to put the annual coupon. I've mentioned that. Okay. So 5% coupon, that is going to be my coupon in this case is going to be 50. Clear?
Yes.
Next, redemption value. Redemption value, if nothing given, it is assumed to be a par 1000. Sorry, redemption date. Yes. What is the redemption date?
15th February.
28. 15th February 28. So I'll put
2.1528.
1528. Redemption value will be 1000. Actual by actual is what we have to use, right? So if not, you'll change it by pressing second enter. 2 by Y is a default frequency. Your yield is 4.8. Correct. Then you'll get PRI, then you'll add accrued interest, and then you'll get the full price. Now, before you all go ahead, I want you all to calculate the accrued interest. Accrued interest. What will you all do? Go to the, I mean, for exam, you don't have to do it, but just for verification, go to the date function. Let's go to the date function. Put the date 15 February 2019. So the date 1 will be 2/15/19. Enter. Your date 2 will be May 14/19. 5/14/19. Enter. And your day count convention has to change to actual. Let me know how many days you get.
88.
Okay, 88 is what you get, right? Keep that in mind. and how many dates you have in between 15th February and 15th August. See that. Go to back to the date function. Now date 2, put 15th August. Put 15th August. So 8, 15, 19. Enter. And now calculate the days. You'll get 181.
Yes.
Right?
Yes.
Okay. Now, if you want to check, so how many days you have from 15th February to 14th May?
88.
88. And how many total days you have from 15 to 2019?
181.
181. So basically, if you just want to verify this, it is 88 days over 181 days. And I have taken only 181, not full year. Okay. If you take full year, it will be more than this, right? So if you take 88 divided by 181 into the half yearly coupon, what is the half yearly coupon? Take it 25. Multiply that. 88 divided by 181, multiply with 25. How much is the value that you get?
12.155.
Yes, probably this is the value that we should get. However, we'll verify that when we do the calculation. Okay. So now, everyone has written the functions. Let's go to the calculator, everyone. Yes. So on my screen, what is the function for bond? Which function will I put? Second?
9.
Second 9. The first thing you get the settlement date. I will put 5, 14, 19, enter. With me, everyone?
Yes.
Coupon is going to be 50, enter. Redemption date is 2028, right? So February 15, 28. Am I correct?
Yes.
Redemption value is 1000. Day count convention from 360, I need to change. Second, enter. Correct?
Yes.
Frequency remains the same. Yield is 4.8. Enter. I will get my PRI. When you come to PRI, press compute. You will get 1014.09.
09.
Store this somewhere. Store this value. Store 1. Press store 1. Now press down arrow key. You will get your accrued interest as 12.15. Is that clear?
Yes.
Store this value. Store 2. Store 2. Okay. Everyone. So tell me, what is your recall 1? Recall 1 value?
1014.09.
1014.09, right? Rounded off. Yes. And add recall to your accrued interest, you will get your actually paid value. That is 1026.24.
24.
Correct. This is called the dirty price. Is that clear, everyone?
Yes.
Anyone has any doubts? Correct. Everyone clear what is clean price, what is dirty price, and what is accrued interest? Everyone? Clean, dirty, and accrued interest. Anyone has any questions? Please let me know. Yes. So the way we've done is that first, see, you know what? Put that habit first, put that in the timeline, then put that in the equation, and then do the calculation. Now, I get a lot of questions from students that, sir, how much time will we spend on this? Isn't it that we'll spend too much of time on this? And how will we do that in exam quickly? Do we have to write it manually? Well, of course, you don't have to write it manually, but the more you do this practice, the easier it will be. Now, since you all have done this written practice with me, now next time when you see the question, you don't have to manually write it. Yes, but it's better if you do a timeline. Once you do a timeline, it will be crystal clear for you that, okay, from which point to which point exactly I'm moving. So plot the timeline, then press the bond function. So the bond function will automatically tell you what are the inputs. Just press the down arrow key. You just need to fill up those inputs. And then you get PRI, that is your flat price. At the accrued interest, you get the full price. Is that clear? Now then you go and check out in the question whether they've asked you the flat price or accrued interest or full price, what exactly they've asked you, and accordingly choose your answer. Clear, everyone?
Yes.
Right. So both the sums were similar. In the first, the day count convention was 30 by 360. Here it is, the day count convention is actual or over actual. The reason I did the day count convention is for you all to just understand what is the logic behind it. So here we had how many days? We had 142 days in between the two coupon out of, you can say 180 days, or you can say 360 days, and you can take the full coupon, whatever you do. And then we solved the same thing. And so the day count convention, I thought it just to verify the accrued interest. Otherwise, the calculator does the job, so you may not have to do it. Very crucial calculations. Is that clear, everyone? Anyone, any doubts with this?
No.
No. Okay. So we have covered these parts till now. And now we move to metrics pricing.